Hello, everyone. In this lecture, we're going to be speaking about financial intelligence. We're going to cover these skills. What is financial intelligence and why is it important to non-financial managers? We're going to go over a quick view of finance versus accounting and what are the different types of finance and the different types of accounting, and why profit does not equal cash, and what is cash versus accrual accounting. So what is financial intelligence and why is it important? Well, to understand the basic measurements of financial data for a company provides you with the ability to read and understand financial statements and to know the difference between profit and cash. There are certain rules and estimates and assumptions that you'll be made aware of in these financial statements. You'll learn how to conduct an analysis of the numbers using ratios to better understand the the financial health of an organization. And you'll also learn that while we'll be focusing on the numbers in this course, that the numbers do not tell the whole story of a company. And once you learn to understand these things, you'll have the ability to critically evaluate a company, and you'll have the ability to ask certain questions of things that you don't understand, but you'll feel comfortable about asking those questions. And it also provides you with the ability to make well-educated decisions. So first, we're going to get into finance versus accounting. And what is finance? So finance is the study of money. And its activities that relate to banking, lending, and investing. How can we acquire funds for our company? Should we take out a loan from a bank, or should we invest in stocks to generate more income? And it's the study of the financial statements to be able to make future decisions. Whereas accounting, on the other side, it's the process of recording financial statements. And from recording those financial statements, the accounting side of the firm will put together these financial reports so that the finance people can then understand, learn, read, and interpret the numbers that are going on. And accounting, of course, as you know, it can be used for professional and you can use it in your personal life as well. There are different types of finance and accounting. This is just a tidbit of the different types of finance and accounting. You have personal finance, and this is when you develop strategies for your own personal use. You want to set up a schedule for yourself for retirement planning or paying off your credit cards. In corporate finance, these are strategies developed for professional use. Should we get bank loans? Should we use an angel investor? So that's looking at financial statements from the corporate level. And public finance is looking at financial statements from the government level, where government agencies develop strategies to pay for the services it provides to the public. And then on the accounting side, there's financial accounting. And financial accounting is when the financial reports are prepared for external use for investors or lenders. Managerial accounting is used for internal preparation of the final financial statements so that management can make financial decisions. And cost accounting is used internally, and it compares the cost of the production goods against the profit of the company and what they earned by selling their products. And it helps a company to establish a budget for projects of a similar nature. So why is financial intelligence so important? So we went through all of the things that financial intelligence will arm you with. And first, we're going to cover the ability to read and understand financial statements. So there are three major financial statements for a company: the income statement, the balance sheet, and the cash flow statement. What financial intelligence also arms you with is to know and understand the difference between profit and cash. So why does profit not equal cash? And this is when you are looking at the income statement. On an income statement, which we'll cover in later videos, you'll see net income at the bottom or net profit at the bottom of an income statement. But is that really what the company has in the bank? Is that the cash that they actually have? The answer is no. And there are many reasons why. Two of the major reasons why is the accounting methodology that is being used and depreciation. So companies can record their transactions using either the cash or accrual methodology. Public companies typically use the accrual methodology. However, they can change, but they have to provide substantial evidence as to why they want to change. But most often they use the accrual methodology, and we'll get into that in a moment. They use some GAAP rules where it states that revenue and expenses must use the matching principle. Revenue can only be recorded when it has been earned. And also there are several expenses that do not appear on the income statement, such as bank loans and prepaid expenses. And depreciation is a non-cash expenditure, and it is an estimate on the lifespan of the equipment. It affects the company's profits, but not its cash flow. So basically with depreciation, if you purchase a truck for $30,000 and your accountant says, okay, the lifespan of that truck will be 5 years, that's an estimate. I mean, you know, that can go on, that truck can go on and have a much longer lifespan, but in order to record this, there has to be an estimate given at the beginning, right? So that's one of the areas where estimates are being made. And the actual cash a company has is represented on the balance sheet as a current asset. So now let's talk about the cash versus the accrual accounting methodology, and it's all about the timing. Under the cash accounting methodology, which is used by you personally, which is your checking account, and it's typically used by small businesses. So under the cash methodology, cash is recorded when there is an exchange of money, and the money can be revenue or expenses, money coming in or money going out. You can use either methodology up until the end of the year, but you must select one or the other when you are filing your taxes. And as I said, it's mostly used in small businesses. It's non-GAAP compliant, which are rules that have been established by the Securities and Exchange Commission. And as I stated, it's similar to your checkbook. So when you get your paycheck, you make a recording of revenue of what your paycheck amount is. And when you pay your electric bill, you make a recording, and that's cash going out. Under the accrual methodology, revenue is recognized and recorded when it is earned, and expenses are recognized and recorded when they are billed. And it's required to be used by publicly traded companies for conformity and comparison analysis. So I'll give you an example of how this works. So step one in this example, a customer sent you $2,000 for a bill he received last month. Okay, so you received $2,000. Under the cash methodology, you have to account for that cash because you received it. Under the accrual methodology, you wouldn't accrue anything because the invoice for that $2,000 was sent out last month, and that's when you would have recorded it under the accrual methodology. Next step is you sent out an invoice for $500 for a project that's to be completed later this month. Remember, when you send out bills, when you send out invoices under the accrual methodology, that's when the transaction is recorded. Under the cash methodology, you sent out the invoice, but you did not receive the cash yet. So you would record 0 under the cash methodology and 500 under the accrual methodology. Next, you paid $125 for a bill that was received last month. Under the cash methodology, you paid it out. You took that $125 out of your account and you paid it. Cash has been exchanged. So the transaction under cash would be made immediately. But because that bill was received last month, you would have recorded it under the accrual methodology last month. So for this month, there is no transaction made under the accrual methodology. Next, you receive a bill from a vendor for $200. Under the cash methodology, I received the bill, but I haven't paid it. So there is no transaction recorded under the cash methodology. But because I received a bill and because of the accrual methodology and GAAP rules, I must record that as an expense because I received the bill this month. So now we're going to look a little bit about, we're going to look at the income statement of cash versus accrual based on all of the transactions that we just went through. So if you see that we recorded $2,000 in revenue under cash and $125 of expenses under the cash basis, which leaves us a net profit of $1,875. Under the accrual basis, it's much less. However, the month before may have been much more because that's when we would have recorded that $2,000 in revenue. So this is just to give you a snapshot of how the two accounting methodologies can differ. So now I want to touch upon depreciation. And depreciation is a methodology that accountants use to spread the cost of a capital expenditure over its useful life. And what is a capital expenditure? It's property, plant, and equipment. And the IRS does have some guidelines on the lifespan of certain items, such as computers and furnitures. And usually you can depreciate items that have a value of over $1,000. And that's something that's set by the IRS. So if the IRS says, if you purchase a vehicle, the lifespan is 7 years. Well, then you have to use 7 years as the lifespan of that vehicle. So if you purchase, as we stated earlier, if you purchase a piece of equipment for $10,000 and you expect it to last 3 years, that 3 years is an estimate or an assumption that your accountant has given you to say, okay, this is what you're going to use. And then that $10,000 will be spread out on the income statement over 3 years. So here's an example of how that would look. So on the left side, we're looking at, I know I have these labeled the same. So the left side is income statement without using depreciation. It's taking that $10,000 and just plopping it in your expenses on the income statement. And there's that under selling, general, and administrative expenses. You see that entire $10,000. Well, my net profit is $10,000. Then on the right side of the screen, the way I would depreciate this is that $10,000 over 3 years, which comes out to $33.33. And you can see that my net profit has increased, right? So this is just an example, another example of how profit does not equal cash. And then we're going to get back to one of the other items about why financial intelligence is so important. It's understanding rules, estimates, and assumptions, right? So the rules are GAAP rules, generally accepted accounting principle, and all public companies must adhere to GAAP rules to ensure conformity, completeness, and consistency. And in order to stay on the stock exchange to be publicly traded, they must follow these guidelines. These rules were set in place by the Financial Accounting Standard Board. And some of the topics that they cover is how revenue should be recognized, how items should be expensed, how sales should be reported. If you have pending lawsuits, that must be disclosed on your financial statements. And there are many other rules and principles that are used by GAAP. And if you look into the Introduction to Financial Accounting textbook, page 7 through 8 provides a pretty comprehensive table of the major rules under GAAP. There's also the matching principle under GAAP rules. Company must record revenue when expenses are incurred. So congratulations, you're receiving a bonus in February. And your bonus is 5% of all of the sales that occurred in 2020. And sales in that year were $1 million. So 5% of that is $50,000. So how would I record this? Well, the bonuses are being paid out in February of the following year, but the bonus is being earned on the sales that were made in 2020. So I have to record that in 2020, even though it's being paid out in 2021. So then also with the accrual accounting methodology, companies must record revenue when expenses are incurred. So if you have a business that is based on subscriptions, you can only record 1 month's worth of revenue each month for the duration of the subscription. So as an example, if I have a service and I provide a subscription at $10 a month, a total of $120, on my income statement for month 1, I would show $10 in revenue. Month 2, I would show $10. Month 3, I would show $10, right? Because that subscription services the revenue is only being recorded when services are being provided, and that's 1 month at a time. And as I said earlier, under the accrual accounting methodology, a company can change its methodology, but it must show good cause. So in summary, we've learned the importance of financial intelligence. We've learned that finance and accounting are 2 different things. Finance is the study of money to make strategic decisions, and accounting is the recording of transactions to create financial statements. There are 4 major financial statements of an organization, but for this course, we're going to cover 3 of them: the income statement, the balance sheet, and the cash flow statement. We have discovered that profit does not equal cash, and some of the reasons why is that is because of the accrual accounting methodology, depreciation, and other GAAP rules that are set in place. And then the cash versus the accrual methodology. Cash transactions are recorded when cash is received and when cash goes out. An accrual, revenue is recorded when it is earned, and expenses are recorded when an invoice is received or if an invoice is sent out. Public companies must follow GAAP, and they must also follow the matching principle.